Shah Newsletter here with Mitt Shah from Noble Investment Group. Mitt, how you doing today?
Sean, I'm doing great. Always great to be with you, my friend.
Oh, it's my pleasure, absolutely. So, usually with these things, when I'm talking to somebody who's done a few deals recently, you want to mention those deals, if for no other reason to let them know that I'm paying attention to what they're doing.
Sure.
I'm not even going to venture to try and name all of the things that Noble is doing right now. So I'll put that on you to see if you can remember everything Noble has been doing lately. So walk us through all the activity you guys have had of late.
Sure. Well, we had a really terrific year from a capital deployment standpoint, and some of that is kind of intentional what we went into last year with. And the rest of it was really due to the opportunities that came into the marketplace, and given a lot of the dynamics that we faced last year, from January of last year was fantastic. Sitting here with you, I think last year, we were trending 8% up, same store. Then Doge happened. We obviously had Liberation Day, longest government shutdown, a lot of geopolitics, et cetera. And what that did is that all of those consternations across the course of the year really pushed a lot of deal opportunities our way that we had strong conviction for. So if you just kind of, lay it all out, we had investments where we did a separately managed account with 51 Marriott Courtyard hotels, where that we put into a separate investment bucket for us. We also acquired 70 hotels separately and made investments in a number of other new developments that also opened up. So it was a pacing wise, a significant capital allocation year, and I think very opportunistic in that these opportunities came out of really two major things. One is that if you think about sitting here 6 years ago, not really knowing that COVID was going to be around the corner for all of us. But the industry wasn't fully renovated at that time by any point in the stamp. And now we're 6 years, kind of post that. So a significant amount of real CapEx that needs to be spent in order to move performance upwards. The second is there's no immediate catalyst that turns a 1 to 2% RevPAR business into a 5 to 6% RevPAR business in the near term. Now, long term, we're extremely optimistic in terms of where that's going to go. So as I think about the next 3 to 5 years and where we think some really strong secular demand tailwinds occur, it gave us the opportunity to think about capital allocation, deployment, and downside protection. Because the other part of this is that if that portfolio that we acquired over the course of the year, had in place unleveraged yields, also, as people think about it as cap rates, in the eights. And so that's a very positive, and you can finance that at one-to-one leverage at, a very attractive, financing, and deliver, strong, cash flow as a result. So I think that, for us, it was kind of business as usual in a very unusual time and marketplace that took place.
Last deal you guys announced was for a portfolio of Woodspring Suites, I believe. Obviously, you've been bullish on extended stay for a while now. But that segment, it's still doing well. Maybe came off a little bit of it's on a heater post-COVID, kind of cooled a little bit comparatively. How are you feeling about extended stay? And I mean, obviously, you're investing in that space, but why do you think continue to feel good long term in that space?
Well, I think first of all, extended stay across our industry has always been seen as a great asset type, given the consumer and what they're looking for from a duration and length of stay. But in most times, that extended stay asset has delivered a customer that stays, between, 3 to 6 nights. And that doesn't feel very extended stay. I mean, we'll stay here in Los Angeles for, 3 or 4 nights, just being here, right? And so they've been normally been treated like more like suite hotels, which is, again, fabulous business, in our space. There's a customer that has been very proven that is very durable, that needs more flexible accommodations, and something that is 30 plus nights, They don't want to sign a 1-year apartment lease because they don't need it for that
Yeah.
period of time. So having something fully furnished, you have internet, and you have all the amenities that you would want within the room, but something that is less frills in terms of just the breakfast and offerings and all those things, has been a proven demand source in certain types of extended stay products. So what we've been doing with our investments in extended stay in this last portfolio is very consistent with a number of portfolios that we've been buying. And actually, it was a very interesting portfolio year. I would say, the substantial majority of the investments we made were portfolio investments as opposed to individual investments, which I think is part of the dynamic of the market that I referred to. But our business model for that was to acquire existing assets that had strong in-place income streams. So, 8+% unlevered yields, but then flip the operating model such that 2/3 of that revenue base were customers that were staying 30 plus nights. So there's a lot of very positive things that happened at that in that time period. So your housekeeping costs go down. Your role in terms of the customers get much more stickier and much more durable, and that allows you to drive a very higher margin, even though your ultimate rate on those 30 plus nights might go down. The profitability actually increases and expands. And so we've thought about this business as you and I have talked about as really less, call it traditional extended stay, more like extended stay 2.0, which we call branded long-term accommodations.
Yeah.
And that business was very, very successful for us, as we've been really leaning into it over the last few years.
How's the distribution model for that shift? Because obviously you're not finding guests for a 6-month stay on, Expedia.
Yeah. It's actually it's a terrific question. And so, with our data and our analysis, we really focus in what is the profitability of a customer that is there for a week or less? What is our profitability customer that's there for 7 to 29 nights? And what's our profitability of the customer that's there 30 nights and above?
Yeah.
And some of it is the distribution channel. So if whether it's through, the brand channel is the brand channel, but as it relates to the OTAs, et cetera, you're exactly right. They're not booking through those channels. So a lot of it's direct, and a lot of it's that customer base, and a lot of it is staying in traditional hotels or in other kinds of alternative lodging accommodations. And I think what's interesting about
There's
that,
more consistency with an extended stay hotel than an Airbnb or something.
Well, and you get there's safety and there's security and there's reliability and there's all those things. And look, I mean, I just you mentioned a very good comment. Like during COVID, you actually saw a lot of very sticky performance results even through. And it's because there was a significant amount of those folks that were actually using it as flexible accommodations during that time period. So I think what you're seeing is that these brands are now looking at the entire ecosystem of their customer, and they're saying that there are those customers that want to be in traditional lodging, and that might be at the very upper end in terms of the luxury brands. It might be in the mid, in the upscale brands like Courtyard and Hampton Inn and Residence Inn and Hyatt Place and the like. But there's also a customer that wants the trust and the security of the brand that wants a longer duration. And so that's what these brands have been able to capture. So, and it's what our interest is in this intersection between long-term extended stay and short-term apartments. Now, Marriott has an apartment brand, Apartments by Bonvoy,
and Hilton now
and Hilton as well. So stay with where this is going, and it's going where their customers are telling them that they prioritize the value of being a part of their loyalty programs, and they want them to curate these kinds of not only experiences in terms of travel, but in how they live and how they stay and the like. And so I think as we think about this ecosystem, which these loyalty brands are 10 times the size as they were, not that many years ago. It's very interesting in terms of what that shift is looking like. And long story short, that portfolio of this branded long-term accommodations, which now that platform has over 100 assets, that we have. ran 75% occupancy last year. So, it just gives you kind of a read in terms of just the durability of that demand.
So minutes before we sat down to record, you were on the main stage talking, and you said something that I think a lot of hoteliers will be happy to hear, which is you believe 2026 could be a positive year for profit margins.
Yep.
Now, the basis of that is you still believe that it's not a great year for costs or revenue. So how do you get to that point?
Yeah. Well, I think there's a couple things, and I don't. And what I also said was not everything is equal.
Yeah. I'm sure, not across the board.
And certainly in our industry, that is the case. I don't. I think my comment that I made is that. If you're a retail investor, the two main product types is grocery anchored retail and essential retail. It's not suburban malls. It's not a lot of other things that could be classified. I think the same is true in our industry in terms of what asset classes. There is a K-shaped recovery. The luxury customer has proven to be sticky. So when you think about certain asset classes, by the way, that cost element there is also increasing. But if you think about a traditional upscale select service, upscale extended stay, or branded long-term accommodations, there's fewer moving parts in terms of what makes up those expense line items, and labor is the most important one. So I think the combination of there being the availability of labor to where there's fewer outsourced needs in terms of that, which reduces the overall cost. The implementation of technology and innovation that allows for better scheduling, better productivity measures, the betterment of brand standards to allow more flexibility in terms of things that added costs into the system in the past and that can take costs out of. And then a real desire from the brands to take a look at the entire operating model and think about, it's kind of like the zero-based budgets that that all business owners do at the beginning of the year. Kind of break it down and say, what are the things that we need to hold true, and what are the things that can be optional, for us in terms of moving forward. I think all of those things lead us to a place whereby there's more opportunity to take costs out of the system and reduce costs than there ever has been. Now, having said that, I don't think it's equal to all product types and all situations. I also believe that the continued lack of new supply in our industry gives us the ability to continue to drive rate. Again, I also don't believe that applies to every kind of asset class. So I think the combination of those things are kind of make up the ability for us that if you're looking at generally anemic RevPAR growth over the coming year, as we're still dealing with some of the policy dynamics and variety of other things that seemingly aren't happening in the rest of the world, that we can still build a case line for improving margins.
Yeah, for sure. And obviously beholden in that is ownership operators who are creative about finding solutions with the flexibility.
Yeah, look, not to talk our own book here, but during this inflationary environment, it gave us the opportunity to reprice daily, which is we're in the daily lease business. So rate growth was 3x the pace of inflation. For every dollar that in our kinds of hotels that you can generate in rate, you can bring 50 cents to the bottom line. Yeah. So that's an improvement of profit margins in an inflationary environment. Yeah. So I think if ours is a business, as you well know, Sean, it requires a real operating specialty in which to create alpha. Which, oh, by the way, I talked to our institutional investors around the world. They are solely focused relative to their real estate investments on those investors that can create operating alpha. So it doesn't matter if you're in retail or industrial, data centers, whatever the flavor that you might like. Interest rates are not going to be the catalyst in order to create returns. Cap rate compression is not going to be a catalyst in order to drive returns. You've got to be able to buy something, improve it operationally, and then rely on some cash flow production, regardless of wherever the growth, takes you.
Now, maybe you're biased in your answer to this question because the investors you're talking to are investing in Noble and they think, oh, this is great. You guys are doing a great job with our money. But I mean, if you're talking about these big multi-class commercial real estate investments, you look at hotels and you say this is supposed to be a hedge against inflation.
Yeah.
And we've got a couple of years now where you guys are not keeping up with inflation.
Yeah.
Like, how does it impact the view of the industry broadly for those big money investors?
Yeah, I believe that for those that are in our industry that have been here and are real specialists, there's a big divide, I think, between those that allocate capital into our space and those that are specialists.
Yeah.
And so I just go back to it. It's like not everything is equal, right? So not every segment of our business, asset class, is equal. Not every investor is equal in that. And I think the dilemma is you can't treat our industry by just simply allocating capital to it like you would in other areas that you're just making a secular growth bet on it. Having said that, I do believe that the secular demand trends in our business will become more and more evident as things go by, and we're seeing it on a global basis. Meaningfully in terms of emerging middle class. What are they doing? They're not buying TVs and cars and things like that. They're traveling and they're going abroad. So I do believe that the message that our industry needs to continue to reinforce are there secular demand trends that are happening, as well as if you are a specialist in not just our industry but in others as well, you have a greater ability in which to control outcomes on the ground level than someone that's just simply allocating capital into the space.
So as we were walking up here to do this, you joked about us doing this every year. I actually had the thought, since this is the 25th anniversary, Alice, to look it up. Can you guess? I'm going to put you on the spot. Can you guess the first year we sat on camera for one of these interviews?
Oh, wow. Was it 2006?
Well, the first one for you might have been then, but so your first one with H&N was 13 years ago.
Okay.
I believe that was with Jeff Higley. The first time we sat down together at Alice was 2017, so that was 9 years ago.
Wow.
For context, that's also the age of my oldest son, so it's been
congratulations.
a significant portion of my life.
It's a good year.
Yeah.
I love that.
So the question I want to turn that into is, what would you tell yourself from 9 years ago if you could go back and speak to him? 2017.
Yeah, it's great. It's a terrific question. I think about those things a lot, and having adult children and a lot of really talented young members of our team, and kind of like what are the things that I would tell myself. I think at that time, I'm just trying to think about just the moment in time that we're at. Our investments coming out of the GFC in 2013 and 2014, some of the best investments we ever made. But that was 6 years after Lehman failed, right? Kind of just think about that clock. And in 2017, I would have seen kind of that outcome. I would relate him to my then self to say, this was our business, continue to invest in the talent on our team, but understanding there are these moments in time where if you have the ability to really, lean in and kind of make investments because of, fear in the marketplace, gaps in capital, not obvious to a lot of folks, have the conviction, to focus on the fundamentals, what you can do with it, because those moments in time, while we've invested across every single cycle, from 1993 all the way through today, there are those moments in time that are just powerful because of the things that that come to play, and have conviction around your team and kind of capital allocation in that time period. So that's kind of the business side. The second piece that I would say, to myself, 9 years ago. In that is that make sure that the people that are closest to you, that are professionally, that also are some of your very best friends, continue to hold them incredibly close in your life, because one of the things that I think has made a tremendous impact on me being in this business is I've met some of the greatest human beings that have helped me be a better spouse and a better father and a better leader. And I was honored to recognize one of those in Arnie Sorensen last night.
Yeah.
And Mark Elliott was another, and Corey Oakes was another, and Ray Bennett was another. And these are like four of my dearest friends that I spent a lot of time with in those years, and gave me the ability to really think about things that and understand and actually believe in myself, and give me great joy in my life. And so they're no longer with us, but they're still with us. And I think part of that is just like, don't miss the fact that life happens, and so this, I think one of the things about the reason why I enjoy this so much is that the people you meet in this industry and in this business, and if you really take the time to walk around and to be at conferences like this, the relationships that you make,
for
and
sure.
it's just it creates so much joy in your life, and I think just being mindful of that in a material way is what I would remind myself.
Well, I don't think we're gonna be able to end on a better note than that. So thanks a lot, man.
Thanks,
really
Sean.
appreciate it.
I appreciate it, man. Thank you.
Hello, I'm Luke Haynes, People Newsletter Editor, CoStar News, and the host of Top Credentials, a monthly podcast exploring the colourful careers of those working at the top of UK commercial real estate. In the episodes, we discover the valuable lessons influencing the daily decision-making of property sector leaders, and hear about the aspects of their job that make it a little easier to get out of bed each morning. We'll also ask for their views on the latest news and policies shaping our constantly evolving industry, and even get them to share a famous quote or song title they think defines their career or the profession. Listen on Apple Podcasts, Spotify, or wherever you get your podcasts.
This episode of the CoStar News Hotels podcast was recorded on January 26, 2026 by Meredith Sheridan at the America's Lodging Investment Summit, and edited for podcast by Sean McCracken. Head to costar.com/hotel news for more coverage from that event and more. You can find all of our podcasts on Apple, Spotify, YouTube, or your platform of choice.